Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He tells us how they reacted to the events in the Middle East and whether gold and crude took off. InsideTrackTrading.com President Eric Hadik examines the cycles that appear to affect financials and conflicts in the Middle East. He says things seem to get violent in the Middle East every 17 years. He also looks at crude, the U.S. dollar, and gold. John Kaiser, publisher of KaiserResearch.com, digs deep into the mining juniors and what is putting Canada's resource industries on the back burner of the economy. He says Canada is no longer a favorable country for mining. We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to the show.
Good to be back with you, Jim.
Ross, how would you describe the stock markets this week?
Well, this is one of those weeks where you got to go back in history a little bit, and if you've been around, you know that when there's a black swan event such as we had a week ago, and the situation with Israel and Hamas being the way it was, that news like that, typically the market will shrug it off, even though it's a big headline item and has the chance to accelerate into something much, much worse. Initially, markets tend to shake things off quite quickly. If we think back, you look at something like the JFK assassination back in 1964, the market bottomed on the assassination. You look at long-term capital, LTCM, in 1998, when the problems arose there, and by the time they became publicly known in terms of what it was, the market literally bottomed on the day of that news, and the crash in 1987 bottomed out really quickly, double-based over about the next 3 or 4 weeks, and before you knew it, we were back at all-time highs within a year and a half. You look at 9/11, another big black swan item. Markets were in a pretty hard downtrend when that happened, but they bottomed out very quickly. And, within about 6 weeks, markets were up 23%. So this time around, on the events in Israel, we ended up with the markets down really for the opening hour or so, and that was it. Had an exceptionally good rally out of that news, and this, it's surprising. There we were with a market that was oversold a couple of weeks ago, and we got some very strong weekly buy signals 2 weeks in a row, and the optimum was going to be a rally that would retrace anywhere from 38 to 60% of its decline from the highs. And that's the moving averages, like the 20-week average, which had historically out of this type of signal, like 100% reliability in terms of a rally back to that resistance. And that's exactly what we saw by the middle of this week. So, all that the markets got a really bad hit early on. It ended up being not a bad week overall. S&P up reasonably on the week, gave it a bit back on Thursday, Friday, but seasonal low appears to be in place, and we'll see if we can just have some choppy action on the upside as we move through the next month or two.
Usually when there's trouble in the Middle East, the price of oil spikes. Did that happen this time?
It did, and this time probably more than we've been seeing in recent actions. This one in particular, you had that good move on Monday. The oil had been down to the $82 range last week, or a week and a half ago. On the news, we rallied strongly on the first day, up to 87-ish. Gave it back in the middle of the week, and then as things looked as though they were escalating into Friday and potentially over this weekend, and we'll see what happens, there was another surge. We ended up going from under 84 back to high on the week, closing off the week just under $88. So this has been a good base in oil, under the $84 range since the first part of the year. We took the better part of 2 or 3 attempts to push through there and get up to 95 during the end of September. That was really, into a perfect selling area, and the correction under 84 we had recommended as a buying opportunity. And I think at this point, that $84 low is one that needs to hold. And with the market moving up on the news, we've got to be careful that we don't let it settle back too far. So look at that $84 as pretty critical support level.
Was the hike in the oil price justifiable for the immediate increase at the gasoline pumps in Vancouver?
Well, the immediate increase. I don't know where you're getting your gas, but I've got the cheapest gas here that I've had in months.
Well, yeah, maybe I am just buying it in the wrong place. Shyster's Corner gas store maybe isn't the best place to buy your gasoline. What's going on with the U.S. and Canadian dollars?
The gasoline futures overall, we were up around $2.90 on the futures price in the summer when you're into the heart of the driving season, and gasoline has really dropped off quite a bit, down to about $2.20 10 days ago. And even with all that was going on with oil prices, the gasoline prices stayed down. We're at about $2.27 on the wholesale price right now, and that's testing the lows that we had back in December of last year. So this action has been one of just a normal seasonality where that's a point where heating oil starts to come into demand and gasoline drops off.
Anything happening with gold?
If you'd asked me 2 days ago, I'd have said we just had a little bit of a jump on news and not much else was going on. And then as of Friday, the market really took off. We ended up having one of the best days that we've seen in a long time as far as gold is concerned. Up, depending upon whether you're looking at cash or futures, it was a $60 a day on the upside on Friday. And it would come off what looked to be a reasonable low down at under 1840 here 10 days ago. Thought we could get a little bit of a move, and when the news came out last weekend, got that first pop up around 1880, 1890, and it gained steam just at the tail end of this week. So I'm a bit surprised. I thought that it would have a move off the bottom, but not to this magnitude. The one thing that does show up, the commitment of traders numbers this week, we saw the remember these numbers are compiled as of Tuesday, and at that point, the speculators had reduced their overall long positions by 10,000 contracts and increased their shorts by 10,000. On the other side of the coin, the commercials were doing just the opposite, and they were making new purchases, sort of a net change in positions of about 20,000 contracts towards the long side from the short side. So clearly commercials were taking advantage of the weakness we've had in this last couple of weeks to really add to their bullish positions in here. And that, in turn, I think is telling us a story in terms of why we saw that $60 run going into this weekend. Many of the specs who have been short this one in anticipation of a continued decline found themselves on the wrong side of the coin. And $60 in terms of a futures move, that's the size of the margin requirement. So I'm sure that there are going to be some very, very big margin calls sent out, and wouldn't be at all surprised that those who had been covering their shorts ahead of the weekend will be happy that they've done that.
Ross, thank you so much for the update.
More than welcome to be on board with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Eric Hadik next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Eric Hadik, CEO and President of InsideTrackTrading.com. Welcome back to This Week in Money.
Oh, well, thanks for having me back, Jim.
Eric, before we get into the interview, can you tell us a bit about Inside Track Trading?
Inside Track Trading is a financial advisory service with various publications that focus on a cyclical and technical analysis approach to the markets. We provide longer-term analysis for more of your investors and also some short to intermediate-term trading strategies and analysis via our weekly relay.
During the past 2 years, you kept warning about the return of Middle East cycles in September and October of 23. How did you come up with those specific dates, and what do the recent events in Israel reveal about those cycles?
Well, those war cycles are ones that I have talked about for years. In fact, some of the specific cycles that factored into that analysis are ones that I've tracked for probably 20 years now. But it's the synergy of a broad spectrum of longer-term cycles all coming into play in late 2023 that really had me taking notice. And really, synergy is the key to just about all of what I do. And I think if there is a holy grail in the market, which I'm not saying there is, but that holy grail might be synergy, looking at the convergence of multiple corroborating, often non-correlated analysis, fundamentals, technical cycles, whatever they may be, coming together at one point in time or at one price level in a market. And it just increases the credibility of and often the accuracy of those different forms of analyses. But in the case of the Middle East war cycles, the first thing in explaining that I do is step back one step and look at the broader war cycles, global war cycles that I've talked about with you for the last 6, 7, 8 years. And I remember some of our interviews several years ago when things were flaring up around North Korea and a couple other hot spots around the globe. And you'd ask me about the war cycles I'd written about, and those things, corroborate that. And as I kept saying every time, I was looking at the time frame from late 2021 to late 2025 for this really escalation of global war cycles. And so those other things were kind of blips on the radar. They certainly may be some precursors, but my focus was on the time frame that we've entered now. And along with that, I almost always look for cycles, events in cycles to intensify as you're nearing the culmination of that cycle. So those global war cycles, which I documented how they were very closely related to European and American war cycles, they certainly received initial fulfillment with the Russian invasion of Ukraine. They started mounting troops on Ukraine's border in late 2021, and then it was first couple months of 2022 when the invasion took place. But at that point, I started looking at the midpoint of that cycle, late 2023, as when I thought we would see an intensification and an escalation of overall global war cycles, but with a focus then on the Middle East. And I've documented, I've got several reports that I put out over the last few years. In fact, there's one that I would be happy to send to any of your listeners that email us or contact us via our website. But it is a collection of analysis that I published in 2022, and it was just talking about Middle East war cycles return in late 2023. And I showed how you've got a 100-year cycle, a 50-year cycle, particularly not just the Middle East, but over the last 150 years, a lot of that focus has been surrounding Israel, because most of the significant conflicts there either somehow involve or target Israel. Even when you had the Persian Gulf War and Iraq invading Kuwait and the resulting attacks from the U.S., Iraq was trying desperately to unite some of its Arab neighbors on its side, even though they were all involved in the coalition against them. So they started shooting scuds into Israel to try and build up that Arab unity. And so eventually Israel got pulled into that one. Although, the U.S. tried to really convince them not to retaliate, to keep the coalition intact, and that we know how things evolved from there. But if you look at over the last 100, 150 years, and this 50-year cycle that I was talking about with the Middle East and with Israel, that it's actually very specific that some of the key events on that 50-year cycle basis come into play right in the September-October time frame. And you had all the way back in 1873, you had what was called the reorganization of Palestine. And then in September-October of 1923 was when the Palestine Mandate went into effect from the League of Nations. Then September-October of 1973 was the Yom Kippur War. And so that 50-year cycle was telling me that the whole thing surrounding Israel and Palestine was going to flare back up in September, October of 2023. There was a corresponding 25-year cycle of Arab-Israeli conflicts that went back to the first Arab-Israeli war that really escalated in October of 1948, and then the Yom Kippur War in 1973, and then the Y River meetings, which, when they start to fall apart after October 1998, was what led to another intifada and eventually Hamas getting into Gaza. And so those cycles were pointing to October of 2023. And there's a lot more. If I tried to really detail all of them, that there's ones that are very closely related to the sunspot cycle, and what is an approximate 11-year cycle. And all you have to do is look at the many of the major Israeli wars over the last century, and they've reverberated on a very close 11-year cycle in 1956, 1967, then in 78, 79, you had, it wasn't directly Israel at that point, but you had the Islamic Revolution. 1990, you had the Persian Gulf War. 2001, you had 9/11, which turned into a Middle East targeted war. 2012, you had the Syrian civil war and the rise of ISIL. And then 2023 was playing into that 11-year sunspot-related cycle. And there's a host of other cycles. It's, like I said, they're detailed and laid out a bit more in these reports that I've done. But everything was saying to me, and even in my October newsletter, published at the end of September, I was reminding readers that September, October was the time for Middle East war and conflict cycles to flare back up. But the intriguing thing to me is that there's another very uncanny cycle that every 17 years and on a broader basis, every 34 years, has timed Middle East conflicts, and that comes back to play in 2024, 2025. So you've got this synergy of all of these cycles coming into play. And so I think the recent events are really just the first shot in a much broader conflict.
For almost a year, you've said that energy markets should peak in mid-September. That's exactly what they've done, but wouldn't the Middle East turmoil boost the price of crude?
You know, it would if it really expanded and really involved a lot of other nations. But this has been one time where of interest. A lot of the other surrounding countries have not really jumped in rhetorically into the fray just yet. In the past, when you've had conflicts like this with Israel, immediately there are a lot of surrounding Arab nations kind of really whipping things up and wanting to take it to the next level. And you haven't really seen that. And so, you know, it's certainly looking like the chance for a contagion right away is not there. And often those cycles, I've talked about this before, that they're often leading the fundamental events. And so you had crude pretty much skyrocketing into middle of September, and it reached the targets that I talked about the last 6 months and retesting those June 2022 highs. And that was, even though that was reacting on some current fundamental events, like OPEC extending cutbacks, it also was leading into other fundamental events like this that would often shake the market. And so you often get those price highs at the same time that a bullish fundamental kicks in, and thus the old cliche of buy the rumor, sell the fact, or buy the expectation, sell the news, that often the actual event is the end of a trend. And so crude had this combination of weekly, monthly, and even a 5-year and the midpoint of a 10-year cycle all coming into play in the third quarter of 2023, and more specifically mid-September. It rallied right into that time frame and immediately kind of plunged from there. You got a little bit of a bounce on the conflict in Israel, but I think there's much broader things at play here right now that are overriding any fear about a Middle East contagion at this point.
Any thoughts on how all of this will impact the various Saudi-Iranian negotiations for peace in the Middle East?
Yeah, that's something I have been very intrigued to see where it leads to, because if you just look at a couple of the key things over the last 6-7 months, in March you had China brokering the deal, the rapprochement between Saudi Arabia and Iran, and just prior to that, you had Iran signing its 25-year agreement with China to increase their interaction and relations. You've had Saudi Arabia kind of, I think, trying to play both sides. And so there was that initial deal. Then in August, you had two very sharply competing events. You had the U.S. Brokering a deal with Saudi Arabia to try and normalize relations with Israel. And almost the same time, you had the BRICS nations with their annual meeting and inviting both Saudi Arabia and Iran to join BRICS, which would put them economically and more geopolitically in line with or unifying with Brazil, Russia, India, China, South Africa, and then the other nations that were invited. I think the UAE was another one. I think there were 6 nations that were invited to join and expand that BRICS. And so you've got Saudi Arabia kind of, I think, seeing who's going to create the best deal for them. And so these recent events have certainly probably tabled the Saudi Arabia-Israel relationship normalization for the time being. But some of that may also hinge on how much blame is laid at the feet of Iran. And, already a lot of the association is there and the funding that comes from Iran. But if you get anything that's more specific and more documented, that may push Saudi Arabia a little bit more into the U.S. and Israel orbit, but that remains to be seen. I think it certainly is the timing of this recent attack in Israel is certainly playing into all of that Saudi Arabia-Iran movement.
How does all of this fit in with your analysis for the U.S. dollar to rally from mid-July into mid-January of next year?
Well, to put that in context, that rally is most likely what would be a B wave or a second wave rebound after an initial decline. The dollar index reached multi-year upside targets in late 2022. It completed some 7-year and 14-year cycles from its not only from its major low, but from many other key turning points. So there were a lot of factors setting up for a major top in the dollar. It saw its initial decline into mid-July of this year, and at that point, it was holding some key support levels. There were some rising support and timing factors coming into play that told me we should see a strong rally in the dollar for the second half of 2023. But the potential for a very decisive and very pivotal peak in January, and most likely a secondary or lower peak, that really kind of cast shadows before as far as what the markets and what the geopolitical structure could be portending for 2024 and 2025. And for me, it just kind of reinforces all of these things we've been talking about, including the BRICS nations lineup and unification, and a lot of the push throughout this last year, but even for the last several years. One of the things that correlates or corresponds to the BRICS nations and what their goals are is to reduce the U.S. dollar's role in global trade and as a global reserve currency. And the one thing I try to stress to readers, to listeners, is that doesn't mean that all of a sudden the dollar is going to be supplanted and something else is going to substitute for it. But if you just saw a move from a 10% or a 20% shift in global trade, global reserve currency, that would have such a major and magnified impact on the U.S. dollar. And in 2024, 2025, I think you're going to see more of the drum beats, hear more of the drum beats in that anti-dollar collaboration. And so as the markets sense that shift in psychology, that's going to weigh on the dollar. And I think at a couple of specific times over the next 2 years, based on a lot of indicators I use and some timing and cycles, I think there's a couple time frames when the dollar will be particularly vulnerable to some sharp sell-off. So I'd be looking for fundamental events and announcements surrounding those time frames. So I think it's, even though this is something, this analysis for this approximate 6-month rally in the dollar, even though that's bullish in the near and intermediate term, it's something that's setting up for a much bigger downturn out in the coming years.
Stocks followed your outlook for highs in early August and mid-September, and some of your recent analysis explained how they may have bottomed in early October. What's the outlook now?
Well, the second and third of those time frames that you mentioned, the mid-September high and the early October lows, are part of multi-week swings that I'm following and attempting to trade in the stock market. But the late July, early August time frame was something a bit more momentous when, as I kept explaining to my readers, and I think I discussed with you back before that I expected what I called a danger period to arrive after that time frame, after that potential top. And the markets often, I just used this phrase a few minutes ago, cast their shadows before. I believe that comes from a Lokiel's warning story. And it's that idea that there are things that the market senses. And, I'm not trying to make that sound as some mystical, esoteric thing, but the market is a distillation, a combination of all the different players and factors. And often there are big players that are aware of developing fundamentals. Might just be one at a particular point in time, but they're certainly going to be protecting their financial interests when they see certain things coming, whatever that may be. And so the markets often reflect this very subtly at first, and then growing in intensity and clarity and its obviousness as those events get closer and closer. But that's where cycles and some of the timing technicals that I use are so effective in anticipating some of those external events. And so when this danger period was entered in late July, early August, it was also a big turning point in some of your leading and weaker stock indexes. And when I just was talking about the dollar wave structure, where the dollar saw an initial 8 to 9 month decline into middle of this year, and then it's having a 6 month, potentially 6 month rebound. And after that, there's some more bearish potential. You've seen similar things on a leading time frame in some of your key stock indexes, like the Russell 2000, where its major peak was in November 2021. It dropped into June and September of 2022, so double bottom there. And as it struggled to rebound from that point, it really was in a trading range for almost a year, setting similar highs on 3 or 4 monthly occasions and similar lows at similar intervals. It was seeing some major topping action unfold and some key indicators kind of turn down and start to apply negative pressure on that stock index. And that was one of the ones, again, it has often given some warning signs early before your stronger indexes finally set their peaks and finally give up the ghost, so to speak. The Russell has been one that has often been the canary in the coal mine, and I was looking for it to top out around 2000 in late July, early August, and begin what could be a new 1 to 2 year decline in that index. That doesn't mean that the other indexes have completed their rebounds, but it's kind of showing you that we're entering the next phase of this major multi-year transition in a lot of your stocks. And so the early October cycle low that you mentioned there is something that's more of a multi-week cycle. I think that some of your stronger stock indexes could rebound into early November. But I think that we're getting into another very vulnerable period for equity markets leading into and through 2024.
Could stock markets head higher into 2024, 25, and even 26? I
don't see it in a lot of my work. When I was just mentioning that 17-year and 34-year cycle in the Middle East war and conflicts, well, that exact same cycle has timed major stock market tops on a uncannily consistent basis. And I wrote about this a lot back in 2005, 2006, because 2007 was, at that point, the next phase of this 17-year cycle. Prior to that, in 1990, you had seen the stock market top and sell off along with a Middle East war. 1973, you had seen a stock market top, which resulted in a 50% decline in stocks over a 2-year period. 1956, you had seen similar market action, 1939. And so it's been a very consistent cycle, and there is a very geophysical and sun-earth relationship cycle that is that exact same interval. And it was interesting because after I did all those articles back in 2005, 2006, 2007, many of them which are still in the archives on our website, and I had even gotten at that time the 17yearcycle.com domain. A couple years later, someone had forwarded an article to me that described this Earth-Sun related cycle that had been so consistent in these major changes in magnetivity and interaction between the sun and Earth, and it just kind of corroborated what you saw in the markets, even in emotional, psychological, and ultimately military interaction between nations, and it's swinging on this same cyclicality. And so most of my work, and not just the cycles either, I know that's a lot of what we talk about because it's even harder to discuss specific technical indicators and try to illustrate them verbally, but there's a lot of factors, including the wave structure and some longer-term trend indicators, all telling me that there's another down wave in stocks, and so a continued up move over the next 2-3 years, at least right now, is not on my radar and not in my analysis. If something happens over a 3 to 6 month period that tells me part of my analysis is wrong, then I'll discuss that, address that and discuss that and see what ramifications it might have. But right now, I don't see that at all.
Gold rallied on news of conflict. Do you expect to see a follow-through?
Well, I think that gold is coming into a time frame, that being 2024, when I think it's going to see its second major advance, the first one being from late 2022 into early May of 2023. And so I think from a longer-term basis, yes, but I think it's going to have some headwinds like the U.S. dollar strength that we've continued to see, like the fact that interest rates have not really shown any hope of heading lower, and with higher interest rates being a burden on gold and silver. So there's some headwinds right now, but I think some of those headwinds are going to dissipate in early 2024. And I think that's when gold will have a much better upside potential. It often has some safe haven status with turmoil and conflict, but often that is very short-lived unless that turmoil or conflict not only continues to unfold, but at that point it has to keep magnifying almost on an exponential basis to keep gold surging on that safe haven status. You'll get your knee-jerk reactions in gold and silver, but it's getting something more long-lasting that is the real key. And I do think that gold and silver very well could have put in a secondary low this month in early October. It's interesting to me that when you look at the last multi-year advance in gold, which occurred from late 2015 into late 2020, that whole 5-6 year move that you had in gold is a similar magnitude of rally as to what I expected to start in late 2022. So another multi-year rally in gold. And so if you compare the two time frames, it's kind of interesting to me that initially off the late 2015, early 2016 low, gold and silver rallied for 7 to 8 months, and then they retraced for the subsequent 5 months. And during that 5-month sell-off, gold lost 70 to 75% of its initial gains. Well, since late 2022, gold rallied for about 8 months, just as it did in 2016, and peaked in early May. And early October was the completion of a 5-month decline, just like it did in 2016. And with gold's recent spike lows, it retraced 70 to 75% of its initial rally. So both in a timing and a wave and a retracement basis, you've got some interesting parallels to 2016 and early 2017 in gold occurring right now. But there are also some stark contrasts, which I think could lead to a breakout higher in gold sooner than what you saw back during the 2016, 2017, 2018 move. So although there are some similarities right now in the two potential bull markets, I think that this one is going to ultimately act much differently because of where it is on a higher magnitude wave structure. But I'm looking at 2024 as being the time frame when that really kicks in for gold.
Eric, where can listeners get more information on Inside Track and the Weekly Relay?
Best place to get any of that information is at our primary website, InsideTrackTrading.com, and that is inside with the extra I in the middle, so it's INSIIDE, tracktrading.com.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim. It's been a pleasure.
My guest has been Eric Hadik, CEO and president of InsideTrackTrading.com. Coming up, John Kaiser, next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is John Kaiser, publisher of Kaiser Watch on KaiserResearch.com. Welcome back to This Week in Money.
Jim, it's a pleasure to be back on This Week in Money.
Can you tell us a bit about Kaiser Research, and do you have a special offer for our listeners?
Well, Kaiser Research is an information platform that covers all the Canadian and Australian listed resource companies. It costs $450 US a year for an individual membership. What we have is something like 1,500 companies in the system with all their projects, their financials in there, and a very powerful search engine that allows sophisticated users who have their own ideas of what's going to become important and what sort of company they're looking for. They can go in there and put together very complex company and project level queries, come up with it, and then it's a time-saving platform because of all these links to external resources, the website and so on, where you can then do more detailed homework. So the membership is really more for sophisticated users, not casual retail users. That's why we have the Kaiser Watch system, which is an audio program we do once a week, accompanied by a written version with good graphics. But what the people who are willing to be members benefit from is the Kaiser Research Slack forum, which is a privilege I extend to the paying members, and this is where they can be lurkers or participants. And this is also for those who want to learn how this Resource.Junior space works. This becomes a very helpful assistant in sorting out this very dangerous game of Resource.Juniors.
So what's the deal with the special offer?
So what we're heading into right now is bottom fish research season. And that means I'm actually being a super user of the search engine, going through everything and coming up with the 2024 collection of bottom fish. And these are companies that have been beaten up in the market, but that have maybe one or two missing pieces that can be fixed either with time or through intervention or with a little bit of luck. And the time to accumulate them is now and to the end of the year, and then hope that in 2024 we get an upswing going. So the deal is, if you subscribe now, you will have it good until the end of 2024. So if you did it today, you'd have 2.5 months extra, and you'd be plugged in and be able to watch as I slowly add companies that I've identified as good bottom fish.
What is your favorites collection all about, and how is it done this year?
This year has been a very depressing year for the market in general. The 16 companies I have in there, they aren't necessarily the best of the best in terms of Resource.Juniors, but they're sort of a diversified set of different themes from gold optionality to lithium to gold expiration to advanced copper, tin, all kinds of different sectors, so that people could look at this group and whatever they are particularly interested in, they could end up just focusing on those companies. And I tend to talk about these in my Kaiser Watch program, but as a group, they are down 18.1% as of October 11th, and only 3 of the companies are up anything, of which the winner is Brunswick Exploration, which is up 73%, followed by Canalaska Uranium, up 30%. But it itself, earlier in the year when everybody was being negative on uranium, it had managed to register fairly low, and it's managed to climb back on the recent rise in the uranium price. But as a group, this is indicative of everything. I went and looked at the top my publicly listed mining companies, looked at 16 of them. And as a group, if you take out Cameco, which was up 63%, they were down 13%. So the biggest mining companies have had a rough year. And if you go to the bigger market and look at the S&P 500 and take out the so-called Magnificent Seven, the Apple, Meta, Alphabet, Amazon, and so on, the S&P 500 has also had a pretty dismal performance. So overall, it's been a very disappointing year. And the resource sector itself, after what looked like a good beginning in the first quarter, it has really lagged. And in the last quarter, things have softened, particularly as the market contemplates high interest rates lasting for a lot longer than was initially expected.
What sort of bottom fishing season do you see coming up in the final quarter of this year?
It's going to be a bit tricky because even though they introduced the life exemption at the end of last year, which allows non-millionaires to participate in private placements, this has been a very weak funding year for Resource.Juniors. And companies have been spending money. The financials that that are in the system, they've only really filed to June 30th, July 31st, and we know they spent money in the summer. So what their actual financial condition is going to be tricky to figure out. You're going to have to look to see if they did any financings subsequent to see if they have any money left, because we are heading into a resource junior winter where if you have no money, there's not much money coming into the system. And so the bottom fishing season, for those who are paying attention and doing their homework, it's going to be lucrative for them, but very dangerous if you don't have the tools to home in on those that have money and the story and management that's going to be able to drive the story heading into the new year.
What do you not like about the new CEDAR Plus disclosure system created by Canadian regulators to replace the old CEDAR?
The CEDAR was invented around 1998-99, so that companies with the regulatory filings, which normally would be stuffed in a paper folder somewhere at a securities commission or at the stock exchange, and people could go there and give them their driver's license and pull the file and sift through and find out information that way. But with the arrival of the internet, they created an electronic filing system where all documents are created as PDFs, submitted into the system, and stored in CEDAR. And it took you a couple clicks to go from the front page to the company page, and then another click gave you the listing in chronological order, where you could see where the management circular was, the financials, the technical reports, the news releases. They didn't really have headlines, so you never knew what the technical report was about or what the news release was about. But you could get all these original documents, and you could even bookmark that listing so that if you wanted to see ABC Company's latest financials, you would just click on that bookmark and boom, go to the most recent ones, click on it, and get it. So this was a very powerful tool for retail investors to get information about these juniors. But the Canadian regulatory system realized that this wasn't broken, so they had to fix it. So they created CEDAR Plus, and it is a stunning failure. Everybody I have talked to in the industry is just shaking their head. It is like, how can you go out of your way to do such a terrible job, make such an unusable system? I tried to figure out how to use it. It took a minimum 20 mouse clicks or keystrokes to get to being in reach of a useful document. And this regulatory system is so incompetent that even when you got in there, they had the order of the documents sorted randomly. And when you clicked on the header there, it resorted them, but sorted them from oldest to last. And you had to click it again so that you have a chronological descending order, which is what you want to see if you're researching the most recent information. How? They had months to find this. This organization, I have to say, it is so impossible to be so incompetent. It has to be hostile towards the interests of the investing public to design and allow such a horrible design to persist. So that's another reason that if you want to do research, you go sign up for something like Kaiser Research, where all these resource companies are covered, and I do all the behind-the-scenes grunt work and make all this information available, and so that you don't have to plod through the new CEDAR Plus click-a-lot system that the regulators have foisted upon us, fixing something that wasn't broken and delivering us a truly horrible, inefficient information system.
What happened to the Mineral Tenure Act in BC Supreme Court, and does it matter?
You know, I've been quite depressed in the last few months about the destiny of the resource juniors. Back in 2015-16, we also had a period where interest in resource juniors was waning. We were stuck in a bear market. Metal prices were weak. Gold was weak, and we had the regulators approve all this algorithmic trading and short selling on a downtick, so that any incoming money could be stripped out by industry professionals by simply shorting into it. And when the inflow stopped, you kept selling short on a downtick and hammer the price down, and then cascade all the people who bought thinking that they were responding to good news, to turn around and sell and enable them to cover their shorts on an intraday basis. So it was like a risk capital stripping mechanisms that these regulators, who really do not have the actual interest of investors at heart, had created. And then, of course, there was the financing restriction, where you had to be a millionaire, and they became even concerned that you needed to provide all this documentation, even about your spouse, before they would believe that you are an accredited investor. And the street kind of said, I'm not filling out this form with detailed financial information, which goes into the inbox of some company whose clerk's going to print this out and leave it lying around and, facilitate who knows what privacy invasion. So they kind of gave up on that. But they did introduce the life exemption, which it applies to anybody. You don't have to be a millionaire, and unfortunately it doesn't apply to American residents, but the stock is free trading right away. So it also removes this distortion of 4 months when the whole period ends. The Canadian placees all clip the warrant and flip the stock into the market, creating another downdraft. But what's been encouraging me in the past few years is a return to safer jurisdictions such as Canada and the United States because of the rise of resource nationalism in places like Latin America, geopolitical difficulties and corruption in places like Africa. But this year, we've seen some very negative development, all linked to the Prime Minister's obsession with truth and reconciliation, his decision to make Canada a signatory in UNDRIP, the United Nations Declaration of Rights for Indigenous People. And this has empowered Canada's First Nations to stand up and say, yes, we are a special class of citizens. We have rights over all this land, which we've roamed around for the last 3,000 years. And you guys who do not have Indigenous DNA, you can't have any of this unless we say so. And the BC Supreme Court ruled a few weeks ago on a case that the Mineral Tenure Act is not valid in British Columbia because it grants title before consulting the First Nations in whose overlapping territories the mineral claims would be located. And the judge gave the BC government 18 months to fix this problem. And what this really means is they're proposing to turn Canada into a third world concession application type system where you come up with an idea, you apply for it, and in third world countries, you basically wait and wait and wait, and then something magical has to happen behind the scenes, and somebody finally approves the concession. And the magical thing that has to happen behind the scenes is that the right official has to be incentivized to look at this and say, yes, you can act on this, you can grant it. So it's third world corruption. It would be different here. You publicize this, and then whatever First Nations groups in whose territories it is, all of them would have to be consulted and make a decision as to whether or not those claims should be granted. Well, why would they ever say yes? They were all going to say no. And if they figure out why this application was made in the first place, they can then turn around and apply themselves for this land, consult themselves, and say, oh, yeah, we don't have a problem with this. So it's a structural blockade to undermine the traditional exploration method in British Columbia. And if it gets mapped to the rest of Canada, it basically kills Canada. Now, they've said 18 months, the existing claims are valid. You can still stake claims under the current system, and they will be valid. But they basically said in 2 years, the entire mineral system in British Columbia and possibly Canada will end, and everything will become basically the fiefdom of the various First Nations who represent 5% of the population, 1% that do not have mixed blood. And this is going to kill things because already First Nations have to be consulted when you want to get a drill program. And a lot of them don't even bother to respond to requests for consultation. And what does consultation usually mean? Well, it usually means that some sort of agreement needs to be reached where certain costs need to be defrayed and certain monitoring provisions set up so to make sure that nothing bad is done, even though the environmental rules of Canada already pretty much keep an eye on what the resource companies are doing. So this, and what's been surprising is there's not been significant industry pushback. The entire industry is terrified of Trudeau's push to make the First Nations a sovereign over all of Canada's mineral rights, and they're just hoping that common sense somehow works their way around. But if you don't push back, the juggernaut will roll over you. So that's for me, it's kind of like, I'm probably approaching the end of my career covering this sector, because when they shut Canada down to mineral exploration, the Resource-Junior ecosystem dies. All these people training to be geologists, metallurgists, technicians in the sector, all of them will not have a job because the system will have been rigged so that nothing can be done without the approval of First Nations. And the problem with approval from First Nations, because of their overlapping complaints and a lack of, who actually controls what, real decisions cannot be made. So this functionality is being embedded into the Canada's mining future right at a terrible time when the rest of the world is looking at Canada as a source of responsibly mined critical minerals to help with the energy transition.
If roadblocks are being put in place to stop mining, how will things we use get made?
Well, they will. The sad thing is the anti-mining lobby sees mining as dirty and ugly and ruins the environment and doesn't want it to happen in Canada. And there's a group called Mining Watch, which is subsidized by one who really has to wonder what entities, that spends all its time protesting any sort of mining or exploration plan in Canada. And they use their iPhones or smartphones to communicate and don't realize that there's a tantalum capacitor inside that phone, whose tantalum probably came from the Kivu region of Congo, where warlords fight with each other and basically terrorize the local communities and turn them into miners of coltan in the riverbeds and the seams nearby. And they do this pretty much at gunpoint. And then, of course, they sell this coltan to Chinese traders who ship it to Chinese refineries, where they are cheaply converted into the material that gets then delivered to all the smartphone manufacturers of the world. And yes, stuff like tantalum comes from big mines like Araxá in Brazil as a byproduct of the niobium. And this will be reasonably clean and responsible, but it all gets blended together into one big melting pot. So you don't know, even though, say, Apple may be told you're only getting clean tantalum, how can you believe anything like that? So these anti-mining people, when they're stopping mining in these jurisdictions that have like the toughest permitting rules and environmental emission monitoring systems and enforcement systems that actually work, when they're busy stopping this, they're not stopping the productions of the things that go into their smartphones or cars or whatever, because these are being made in jurisdictions where they don't care about the downstream victims, where might is right, where if there are rules in place that should prevent emissions from being dumped downstream on the people who live downstream from a refinery or a mine, well, in a place like China, the individual's interest is subordinated to the interest of the common good. And in places like Africa, everything's subordinated, or Russia, everything's subordinated to the interest of the oligarchs or kleptocrats who run the system. So stopping mining in Canada and the United States will not stop the production of minerals, but the reason that they want to stop it it's just a localized thing. They're actually facilitating the production of very dirty materials that they really cannot live without. Their lifestyles depend on these materials. And so yeah, stopping mining in Canada doesn't mean you won't be able to get an EV. It'll just be made with very dirty minerals. And you will have to, if you're an honest person, you'll have to feel ashamed that what you have done is to make this the de facto reality by shutting down mining in responsible jurisdictions.
What happens to the global West supply of metals if the geopolitical conflict with China and Russia turns hot?
You know, in the context of net zero emission goals and the energy transition, this becomes a serious problem because many of the critical minerals that go into the energy transition, and even the technologies that they go into, many minerals come from countries in the global east, countries like China and Russia. And if we get into a hot geopolitical conflict with them, these goods will stop moving around the globe. And rare earths are the biggest example that we, you know, over 10 years ago, it became an issue. China has an overwhelming endowment of rare earths, and it has no concern about downstream damage of mining it. So it has grown from, you know, producing 100,000 tons in 2009. It was like the total global output was about 400,000 tons, 90% of which came from China, and the magnet rare earths are a key part of all these electric vehicles and other technologies. And then suddenly we're at war with China because it has annexed Taiwan, and we decided that that's not acceptable. Where's the rare earths going to come from to make the cars work? So this is a really serious problem, and in the United States, it's stunning. And Canada, of course, you know, we already talked about how Canadians are mindlessly stupid when it comes to the mining industry. In the United States, they're more cynical. They don't care. The NIMBY movement doesn't want anything in any mining in its backyard. It blocks it when it can. And you look at where, you know, graphics that I produce which show where the different metals, the raw materials come from around the world, and you realize how much of it comes from the global east and also to some degree the global south. And the global south these days is looking at global east, looking at global west and saying, who's going to butter my bread more? Just because the global west represents democracy, a country like India, whose leader has ambitions for autocracy, it's not going to necessarily deal with the United States or Europe. It might be better to deal with Russia and China, to get a relationship going that benefits these countries. And if they end up also becoming entrained in a geopolitical conflict and forced to take sides, Europe and North America, they end up with a very serious supply problem. And there are movements afoot to make people aware that we have a critical vulnerability. And we've already seen it with the semiconductor industry. Now these big multi-billion-dollar factories are being built in the United States. It will take several years to get that done. And there's some cynics who say the only reason China hasn't annexed Taiwan yet is because they know that the United States will have to have a very forceful response if this is done before the semiconductor production capacity has been shifted into friends or domestic shores where it will not disrupt the economy.
What are the best mining jurisdictions in the world?
Now, the best mining jurisdictions in the world are China, Russia, and Africa. And these places have fantastic mineral endowments. And in the case of China, China's state-owned companies control it. The communist authoritarian state controls all aspects of the regulatory system. So things, if they need to happen, will happen. There is no opposition. The hyper-surveillance system that China has erected, anybody who wants to protest in any of these social media networks, they get snuffed out right away. So China is really one of the best mining jurisdictions in the world, but not for independent mining or exploration companies. It's one of the worst. And Russia is the same. Russia has rules where they can nationalize anything at a whim. And in fact, now that Russia's at war with the global West, through its invasion of Ukraine and its implicit threat that it wants to reconstitute the Soviet empire, it's a very terrible mining jurisdiction for foreign companies. But within it, you have operations like Norilsk, the giant nickel mine in Siberia. This is one of the most polluting, horrific mining operations in the world. The nickel that comes from Russia is supremely dirty nickel. It is even dirtier than the nickel that comes out of Indonesia, where the Chinese have invested heavily in factories. And Russia, with the impunity with which it's able to fund its war by selling oil behind the scenes to all these global South nations, it's going to be in a position to supply the world with these raw materials quite easily. And in Africa, of course, you have this corruption problem. You have military coups sweeping across the northern part of Africa, the Sahel, usually with Russian involvement behind it. They set up autocracies. They have this supposed battle with the jihadis that are trying to spread radical Islam through that part of the region. But in the sort of central part, you end up having governments that are hopelessly corrupted. Even when they pretend to be democracies, they end up as kleptocrats, getting a big chunk of all production. And of course, any downstream consequences, Mining Watch can blather all it wants about horrible stuff in Congo. It's not going to change a thing. So, yeah, these places are the best mining jurisdiction in the world if what you want is the minerals and metals that you need to keep your global economy and energy transition goals happening.
What jurisdictions are left in which Resource.Junior still have a chance at discovering and advancing a future mine that rewards shareholders?
I think right now I'm like appalled at what's happening in British Columbia, places like Saskatchewan. The First Nations there have become ever more vocal about how they actually own all the lithium in the ground and that they are the ones who are going to determine what gets done with that. The Yukon itself, it has interesting mineral potential. We have a substantial gold discovery that Snowline has made. But Yukon also has this culture in Whitehouse, which is really sort of NIMBY bureaucrats who want to turn all of Yukon into a park that gets visited during the few months of the year when it's not dark. So that's a jurisdiction I'm very concerned about. Ontario, northern Ontario, the First Nations there seem to be anti-mining, regardless of how much it would benefit their community. The Ottawa-Piscat group shut down prevented or basically prompted De Beers to give up on expanding the Victor Diamond Mine because of the extraordinary opposition that they encountered from the First Nations group. My Niobe Metals, which has a niobium deposit that's in the money, that would be a nice balance to the overwhelming supply concentration that comes from Brazil. The Moose Cree First Nation people in Moosonee, no, they don't want a mine in their backyard. They just want dollars shipped to them to sustain their special lifestyle, which they have claimed to have a right to, a lifestyle that everybody else who isn't First Nation doesn't really have a right to. If they want to have a lifestyle like that, they have to earn income and get hold of it that way. So where do you go? Well, you go to the old mining camps and the Abitibi and so on, where the First Nations really aren't an important presence. But there you're just chasing for stuff left behind by the mining companies. So it's not the really, grassroots type ground unless you're drilling undercover, and undercover is very expensive. And still, once you start a drill program, you don't even know whether your hypothesis is correct or not, but you have to jump through all these consultation hoops. What's the point of even starting? The area that I think is sort of my last hope is Quebec, where the First Nations there have long lived with having their backyard flooded by hydro to make hydroelectricity that has helped Quebec as a province very well. They've learned to make money through this. They've set up their rules for goose hunting and moose hunting season, where you're not supposed to have helicopter activity in certain areas where the moose or geese would be disturbed. And now they are looking at this becoming a world-class lithium district. Now, there hasn't been that much gold or base metals found in, say, the James Bay region of central Quebec, but there are now several world-class lithium deposits identified, and this is kind of like the last hurrah for Canadian resource juniors. This is where I think one should go focus one's attention, and in fact, over the next year, that will be a top focus for me. The other area that I think still has hope is sort of southwestern United States, Nevada, Arizona, Utah. Yeah, the BLM and the U.S. Forest Service, especially U.S. Forest Service, thinks that it's kind of like its job is to prevent anything other than maintain a park out of its giant holdings. So there are still headaches to get permits to get anything done that can be very time-consuming. But these are frontiers where there's interesting stuff still to be found, especially revisiting these old epithermal and carbonate replacement systems that stuck out of the ground and were found and explored during the past 150 years, which kind of fell by the wayside in the past few decades. And now with new technology, concepts for alteration systems and measuring them and understanding the strength of the system with even just maybe a tiny outcrop that doesn't look like a hill of beans, even a hill of beans, there's now potential for sophisticated exploration groups to go in there, do science-based homework, and develop targets that could deliver icebergs of mineralization beneath tiny, tiny tips that the prospectors of yore looked at, poked around, and walked away from because it wasn't obviously connected to anything deeper. So, southwestern United States and Quebec, those are the areas that I am most interested in, unless they can roll back this juggernaut of shutting down mining and exploration in Canada that's just been kicked off by this BC Supreme Court judge.
The lithium price collapsed this year. Forest fire closures in Quebec killed most of the summer exploration season. Your prediction of Lithium Mania 2.0 last year has not become reality. Were you wrong or just a bit early there?
I, at this point, think I was simply early. I remember that weekend when on our Slack forum, somebody posted that they just shut down northern Quebec due to the forest fires that broke out there in late May, early June. And I said, oh no, there's going to be a 4 or 5 month window of intense prospecting in the James Bay area, boots on the ground for the first time ever, taking a hard look at these pegmatites that had been observed in the vicinity of gold exploration targets, and that had never been of economic interest until the last 5-10 years. And that's because lithium was a $200 million market as recent as 2005. And last year, if you take the average price of lithium carbonate as a benchmark, it was almost a $50 billion market, though the reality is because lithium is sold on a long-term contract basis, the reality is that what was sold was probably more a $20 billion market. But the International Energy Agency says if net zero emission goals are going to be met, the ones they set for 2050, limiting the global temperature change to 1.5 degrees Celsius. The electric vehicle component of this, insofar that the lithium-ion battery remains the primary power base for these electric vehicles, by 2030, what's required to keep those goals realistic is a 600% expansion of lithium supply. And last year it was about 130,000 tons, up 10 times from what it used to be. And so we need to get this close to 1 million tons. And that's based on the assumption that the holy grail of the lithium-ion battery industry, namely a solid-state lithium-ion battery, never becomes reality. And this year, Toyota stunned everybody by claiming it had solved a major manufacturing problem that made a configuration that is solid-state hopelessly, impossibly expensive to commercialize. They had solved this and are now planning to deliver a high-end sort of Tesla-type car by 2026, 2027. But you know that with a solid-state ion battery, where it's the manufacturing that's the problem, and you started solving it, by 2030, they will have reduced the cost even more and could be selling Camrys and Corollas with solid-state lithium-ion batteries that have 1,200 kilometer range on a 10-minute charge. And when an EV can do that, who needs an internal combustion engine, especially in light of all this hell now breaking loose in the Middle East and Saudi Arabia and Russia conspiring to jam up the oil price so that their own particular agenda can be served. When you're starting to fill your car, your truck or whatever with $10 to $20 per gallon gasoline, and meanwhile electricity prices are going down because the fracking industry chasing shale oil is generating an awful lot of natural gas as a byproduct, which is going into the power plants to make electricity, which you can plug your car in and refuel. You're going to see this process accelerate independently of whether you believe that climate change is caused by fossil fuel consumption. Now, in 2021, when the EV sector started to really take off, the industry was undersupplied, that the car makers suddenly realized there wasn't enough lithium. And the problem was in 2015, when Lithium Mania 1.0 started, the Australians really moved quickly. They had all these worthless pegmatites sitting there, sticking out in the Pilbara and other parts of Western Australia, and they took a look at them and said, wow, at 10 to 15 bucks a pound lithium carbonate, that didn't matter in the past when it was a $200 million a year market where demand was basically flat. But it did when you look at the scale of lithium required as the EV sector takes off. So they were so successful at mobilizing pegmatite-sourced lithium supply that by 2018 they created the lithium winter, where their supply overwhelmed what was required by the evolving EV sector, and crashed the price below $3 a pound, where it sat between 2018 until early 2021. And that kind of stalled the whole quest to mobilize new supply, because at that price, not very many pegmatites are in the money, and even some of these salar brine deposits, it's questionable also how much money they're going to make for the operators. But that changed in 2021 and pushed the price to $35 a pound, where like almost every LCT type pegmatite in the world is in the money, which tells you, well, this is not sustainable. This year, with the Chinese slowdown, the expected post-COVID rebound not really happening, with Chinese real estate sector imploding and the Chinese people becoming extremely cautious about spending, so the Chinese economy slowed down. Their adoption of EVs, their capacity is enormous. It's way more than they could even expect people being normal consumers to to purchase. So they're now trying to flood the rest of the world with these cheap Chinese electric vehicles, and the Europeans have woken up. The United States has always said, no way, we need to develop our domestic industries. We need our people to have jobs too. And also, we don't trust you guys as, you think Putin is your pal and you're totally behind his invasion of Ukraine, and we know you claim autocracy is superior to democracy. So no, we're pushing back against that. So we've seen the lithium carbonate price plunge from its unsustainable levels down to sort of $10 a pound, where it's now stalled. And it had a rebound back to $20, but then another plunge, like some sort of bungee jumper. And right now it's kind of at the low end, and people are holding their breath. Is it going to break down into the $5 to $10 a pound range, or even worse, below $5 a pound range? And I've seen in my lithium index how the red days, people have been pulling back and selling what they're winners and sitting on the sidelines waiting to see what happens. But with regard to the James Bay lithium play, this is all largely grassroots. What the lithium price does in the meantime is irrelevant. And even in the $5 to $10 a pound range, the rock value of a 1% lithium oxide deposit or better is way in the money, even for underground mining. And these deposits are sitting here, there to have their surface scratched and assayed, and then drilled if it's the right kind, just there for the taking, because they were worthless until this technology innovation of the electric vehicle and the push to make electric vehicles replace the ICE cars. So the forest fire closure, that was so depressing. It basically stole 5 months. Some companies have been able to get in the field and spend time, but some of them even ran into the September 15th to October 15th moose hunting closure, so had to sit out that. And there's now mumblings about an early hard winter coming in the Quebec region, which once snow is on the ground, you cannot explore for pegmatite outcrops. It's over. You're going to have to wait till May, June of next year. So that the combination of being unable to go out there and prospect this area for literally almost 3 months, and the optics of the plunging lithium carbonate price, coupled with this general feeling that we are heading into a global recession thanks to a high interest rates. And by the way, people are for the first time in a decade looking at savings deposits yielding 5 to 6%. Or they can put it, if they have large amounts of money, put it into money market T-bill funds, short-term T-bill funds. And if Powell's saying, we're going to keep short-term rates up there for 2 years, we're talking about risk-free money of 5% or so for the next couple of years. Why would you buy something risky, especially in the resource sector, especially when you know that having such a high interest rate for so long will tank the global economy and reduce demand for metals and reduce prices, and therefore the rationale for finding and putting a new deposit into production.
Do you think Quebec's First Nations will block exploration and development of lithium pegmatite deposits or support it?
So far, they have been cooperative, but because of this forest fire closure, which actually really was bad news for First Nations communities, because it's only First Nations that live in this James Bay region. I mean, there are vast areas of land that have been turned to ashes. It's going to be great for pegmatite outcrop exploration next year, because so much vegetation has been burned. And right now, of course, everything's sooty and you can't see anything. But when the winter snow and rains come and wash it all clean, next year is going to be a big prospecting year. But the fact that so little, all the service contractors, the helicopters, everybody ended up being requisitioned to support fighting the fires in Quebec, both in southern Quebec, where it all really started with a vengeance, and in northern Quebec, to save the communities from getting burned up. That meant there was not a lot of visible exploration activity for the First Nations to notice and say, hey, why is this happening? So next year, assuming that we do not have another forest fire season as we did this year, there is a risk that they will stand up and say, no, we don't want exploration in our sacred territory backyard. But unlike, say, the other First Nation groups in many parts of Canada, such as Ontario, the Quebec Cree do have this relationship with being compensated for the hydro reservoirs being set up in their backyard and having to be maintained and ship electricity to the south. And this is not a great place in the world to live. Nobody's going to move economic activity into the James Bay region, even though Quebec has this Plan Nord fantasy of developing this region. But the endowment of lithium pegmatite that's starting to emerge, this region could be an Australian equivalent source of lithium for the electric vehicle future. And even if the price drops down to sort of the $5 to $10 per pound range, it's still going to be a $200 billion market by 2035. So they face a choice. Do we sit there and say, no, we don't want this part of the world to be a major lithium supplier and help for the energy transition. We want to maintain the status quo and hope that Ottawa sends welfare checks to us? Or are they going to say, this is going to change our area. We're going to make sure our traditional lifestyle areas won't be disturbed. It's not like the whole area is going to become a moonscape of strip mining. It's going to be localized. Many of the mines, because they're so rich, they'll end up being underground mines and not have a large open pit footprint anyways. So I'm thinking that the Quebec First Nations will probably collaborate in productive ways that are win-win for everybody. And that's sort of one reason I'm looking at this area as kind of like the last Resource Junior frontier, where some 10-cent stock could go to $5 or $10 because they put boots on the ground and started looking hard for these lithium pegmatites. But the way Justin Trudeau keeps pushing for truth and reconciliation and saying that this is all like land that should stay undisturbed and nothing be done with. He talks out of the corner of his mouth, does deals with the Japanese about, build your battery factories here. And the Japanese are going, wink, wink. Yes, and you will supply critical minerals. So for our batteries, which is the reason we do it in Canada rather than the United States. And then Trudeau does nothing when one little First Nation of 1,565 people, after collecting payments and stuff for 10 years, suddenly stands up and cancels the agreement they have with FPX Nickel and says, no, this mountain is sacred territory. We will not tolerate a mine in our backyard. And the Japanese are watching this and saying, what's Trudeau going to do about this? Is he going to tell them to, no, you don't have the last say in this? We'll make sure that it's done properly, but no, you don't have this veto. The mixed message he has been sending is harming the future of the mining and exploration industry in Canada. And I used to be horrified at the idea of Quebec separation, but now I'm beginning to think, well, if the rest of Canada is going to become this giant First Nations park with no mining, maybe Quebec should separate from Canada, because Trudeau is putting it on a path of uselessness and bureaucracy with no industry underpinning it at all.
When you look for bottom fish stocks, do you have a criteria list?
Yeah, the classic ones are money, people, and story. Ideally, as I mentioned earlier, you want the company to have working capital that isn't already allocated to option payments or things like that, because we are in a funding winter for the Resource Juniors. When you stripped out from the August financing activity, for which we have stats, you strip out the 4 or 5 very large financings that were done, only $70 million by 45 juniors was raised by TSX Resource Venture junior listings. And there may be a boom for flow-through spending in December, and I think Quebec will get an awful lot of it. But when we're looking at this obstacle course that Trudeau has erected or facilitated being erected against getting any work done in the rest of Canada, I'm not sure how much money is going to be raised for flow-through. So finding juniors that have money left over is going to be key. In terms of people, I watch new listings show up on entities like the Canadian Stock Exchange, and they start off at 30 cents, and they promptly tank to 5%. And when I finally enter them into Kaiser Research platform, I see how flimsy the projects are. I see how flimsy the management groups are, and I say, what are these guys smoking? This sector is dying, and you're floating a publicly listed company. The audience for resource juniors has completely evaporated, and you're just diluting the group with more useless companies. So drilling down who the people are, do they have the experience, do they have the vision to come up with a story and actually execute on it rather than just hire some clowns to pump the stock on their social media networks. That's criteria number 2. But the third criteria is the story. I'm looking for interesting stories, exploration stories, new ideas, to some degree optionality plays, though I think we're going to have another year of weak metal prices unless we get this geopolitical supply disruption that's sort of been lurking in the background. But the area that I think where the best bottom fishing can be done will be like the James Bay Lithium Index, where I've already got 70 members, many of them dirt cheap. And even though most of them don't have a huge amount of money, this is the type of story that could see a massive inflow of money coming from the EV sector, coming from the Australians who are cashing out of Liontown as it gets absorbed by either Gina Reinhardt's Hancock or Alba Marley, and then gets recycled to search for the more lithium needed to feed the future EV needs. So I'm going to have a bias for that sort of sector. I'm very leery of Latin America and Mexico. They've got this crazy new rule that is deadly for resource juniors that AMLO has proposed that I haven't seen reversed yet. And of course, Africa, forget about it. Australia itself, that's really the jurisdiction of the Australian companies. So figuring out what to do there is going to be tough for the Canadian juniors. But I may start looking at Australians companies as part of my bottom fish collection.
Should gold and silver versus Bitcoin really be an argument?
Gold and silver exist naturally in the earth on a dispersed basis, in some places concentrated more than others. And that is a deposit that ends up getting mined. To mine it and concentrate it into a above ground form sucks up energy. So in a sense, physical gold and silver that's above ground is stored energy. And you're not going to be able to make more of it without investing more energy. Bitcoin, on the other hand, is an energy liability. Its supply is fixed by that whatever 20 million Bitcoin mathematical limit that it is. So if you want more Bitcoin, the price of it will have to go up. But Bitcoin is a solution looking for a problem. And to keep it alive requires energy consumption, which will only go up as as Bitcoin expands. So they shouldn't be compared at all. If people want to gamble on Bitcoin and hope there's going to be a sucker down the road that you can unload your Bitcoin to before Sam Bankman-Fried pulls the plug on your account, go for it. But don't package it as an alternative to gold, because the gold and silver exist. Now, most of the gold, half of it's fabricated into jewelry. Maybe 15% is fabricated into some technology doing something useful, and the rest just sits there as bars and coins as a type of investment. And gold does have this problem of, we don't really need more of it. In fact, I hear today there's some article in the Globe and Mail making a case that there should be a ban on global gold mining because we really don't need more gold. And if gold's supposed to be a good inflation hedge, well, adding new gold from the ground just kind of undermines that role of gold. So for hardcore gold bugs, a ban on new gold production would actually serve their interest very well, because then the $12 trillion worth of gold that now exists, it can actually go up in value because you're not allowed to make any more. But it's going to end up going up in value anyways because since 1980, after gold went from $35 an ounce, around $400 an ounce, plus or minus 50, we've doubled the above ground gold stock. And that was a very big, 500% real move in the price of gold from its $35 level. If you inflation adjust gold to the present, the inflation adjusted price of $400 goes $1,500 gold. And in this sort of $1,800-$1,900 range, that's a 25% real gain after 30 years of harvesting low-hanging fruit. So the gold that's left to be found and mined is kind of high-hanging fruit at the current price. And the dream in the resource sector is that gold will punch into the $2,000 to $3,000 range, not because of fiat currency collapse or soaring inflation or anything like that, but simply because people want more gold, and that will drive up the price. And in that range, even though in terms of rock value, it doesn't make a very significant difference, it makes a monster perceptual difference. But $2,000 seems to be the ceiling that gold cannot definitively break through and leave behind as the base for all future price moves. Silver, on the other hand, most of the silver in existence is fabricated into doing something useful and doesn't really have this, insurance policy type category. Though for a lot of people, it's become an obsession to treat it as such. And silver is a byproduct of copper mines, of zinc mines, of some gold mines, and its cost, if you can recover it, you will. But these mines aren't put into production because of silver. So there will always be silver supplied as surplus from other mines, and it will be sold into the market whether there's demand growth or not. And there's, talk about new applications for silver, which will never happen for gold, such as making them part of solar panels. So silver could benefit from that. But the important thing about silver is it's a useful metal that's already fabricated into doing all these other things. So it makes no sense to talk about gold and silver in the context of Bitcoin. Bitcoin cannot replace gold and silver. Bitcoin itself, as it consumes more and more energy, will eventually have the plug pulled on it.
John, before we go, can you again tell us about your special offer and how people can sign up?
Well, we're heading into a bottom fish research season that pretty much ends at the end of the year and then starts the new year. I'm now offering the $450 annual membership. If you take it out now, it ends on December 31st, 2024. So it's kind of like a 10, 15, 20% discount if you subscribe now. And you get to watch. You don't necessarily need to buy it, but get these bottom fish on your watch list. It's going to be a horrific sell-off later this year as people capitulate. And of course, if we get a big market dump in the meantime, this will just accelerate the capitulation. So this is a great time to roll up your sleeves, get your head around the different possibilities in the resource junior sector, and be prepared to swap some of that 5% term deposit into stocks that can go up 500,000% in the new year. John,
thank you so much for being on This Week in Money.
Thank you, Jim. It was a pleasure to be on the show.
My guest has been John Kaiser, publisher of Kaiser Watch on Kaiserresearch.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and John Kaiser. And thank you for listening. If you have any questions for our guests or for the show, you can send them to info@HowStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of How Street Media Incorporated. Executive producer is Tom Allen.